Chinese property developer Evergrande's looming default sends shockwaves through the market. The VIX spikes to levels not seen since May. And all eyes will be on the Fed this week to find out if and when tapering will begin and what the pace of future rate hikes will be. All this and more in this week's Macro Insight. So welcome to any new subscribers or free trialers. Welcome back to Macro Insight. Today is the 21st of September, and let's have a look at these markets. So last week, the markets continued to chop around with a negative bias into the quad witching expiry. We talked about the street becoming a bit less long gamma as normal, a lot of front running of that expiry type dynamic as the market sells off quite regularly now into expiry. That was going on. And we did manage to get our usual sell off into expiry and particularly into the close. But the sort of underlying thing that was bubbling and making markets nervous was obviously this Evergrande default, right? That is coming up in China. And for those who don't know, obviously I'm sure everyone does, but for those who don't, Evergrande is a property developer in China. They've got massive mountains of debt and they've got coupon payments coming up in literally a couple of days. They've got the first one and they've got some next week and then again in early October, and they don't look like they're going to meet those obligations, right? So the Evergrande bonds have absolutely collapsed, are trading for like 20 cents in the dollar. So a default is kind of a foregone conclusion. And what remains to be seen is what the Chinese authorities are going to do in terms of whether they're going to let it be a disorderly unwind and liquidation type event, like a Lehman's type thing, or whether they're going to actually, come in and help with the sort of restructuring of the debt and calm things down, basically, right? That's what the market was kind of expecting or hoping to see maybe over the weekend. We saw nothing out of China, right? They're just kind of letting this thing go for now. And that sent shockwaves through the market. And that's why we saw what was, biggest sell-off we've seen in a while across global markets. So sort of digging a bit deeper into this, the property sector is obviously taking the biggest beating. There's other companies within that sector that are now getting hurt. And real estate makes up 75% of household wealth in China. So the fact that this is the sector under the most stress doesn't bode particularly well for the Chinese consumer and how, the wealth effect on that consumer, basically, right? And given that Chinese demand is quite important for countries like Europe, that's not going to play that well for global markets. Okay, let me share the screen for some sort of charts that I found, to be important for this whole Evergrande situation. All right, so here we've got a few charts that kind of caught my eye, right? So you've got, the first chart on the top left. You've just got you've got the Chinese high yield corporate bonds, general Asia high yield, and then Evergrande itself, right? So this move from sort of May, June time, is being mirrored across the whole space, right? In the whole Chinese high yield market and the Asian high yield market, okay? But then if you look at the chart below that shows you the difference between China high yield rates and China investment grade rates, okay? They haven't budged. So that's already showing you that this seems to be quite localized to China high yield, right? Which for the worry of global markets and the fact that everyone's scared, is this going to spill over and be a major contagion event for other markets? The fact that it's not even really looking like it's spilled over into China investment grade yet, or is going to at all, that remains to be seen. So that should maybe give us some comfort. Okay, you've also got this chart here on the top right. China foreign currency reserves are about $1 trillion. Okay, So if they did really want to, stop this turning into a disorderly event, they can easily do it, right? So they've easily got the firepower to do it. And again, that should give us comfort. Now, they may not have the will to do it, which we'll find out. And, but they've got the firepower to do it. So I think that should give us a little bit of comfort on the situation, basically, right? Now, they have pledged to crack down on capital markets. And we've been seeing that, right? Industry after industry, they're going after, right? And deleveraging the property sector, that's something they wanted to achieve. And this is happening, right? So you could argue this is kind of all part of their plan. I doubt part of their plan is letting this spill over to the entire economy and just crushing everyone. Okay. I mean, there's too many, there's too many jobs, there's too many stakeholders. Unlikely that's the way this thing's going to play out, basically. Okay. And then already you saw on Friday, they did pump in liquidity into the market, right? So that PBOC liquidity injections at the bottom right, they pumped in, as much as they've done since sort of February, right? So there is a will to kind of, steer the ship here. And I think when they come back from holidays after tomorrow, we may get some headlines as to what's going to happen here. Certainly we're going to get some headlines on the coupon day, which is Thursday, to kind of say what the restructuring, if there is a restructuring, what that's going to look like, right? So I think the next few days, we're definitely going to hear more on this. But bear in mind, the bonds are already trading as if it's a done deal, right? They're 20 cents in the dollar, right? So pretty much there's not that much more mark to market to take, basically, right? Even within the local China stuff. Now, obviously, other companies within China have started to get whacked. So, there will be a potential spillover into those, depending on what the outcome is this week. But, we'll keep an eye on it. But I'm starting to think, it's probably going to be relatively contained. Okay, that's my sort of base case. If we then look over to what's been going on kind of in equities, global equities. So S&P, what's been going on? So, yeah, we talked about this kind of vol trigger and the gamma positioning of the street. Similar sort of dynamic happens every time in expiry. So the S&P, broke below, it originally broke below that 4,500 level. Obviously, then it had it moved down and then was consolidating. But then when we broke 44.25 last week, that was your kind of next level to be concerned that, the street really is in negative gamma territory. And so yesterday we had the acceleration down to a key support at 43.50. We kind of tried to hold that for a little while and then we broke lower. And the spot gamma guys put out their levels, and 43.10, 43.15 happened to be their support zone, or what they were calling near their put wall area, where they expected a certain amount of unwinding potentially to be done. And that's basically where we saw a low. And then into the close, we saw a nice rally back up to 65. Okay. So, S&P definitely is in an area where the street is less long and we are seeing wilder moves, right? We saw intraday, 3% down. We haven't seen that in a long time, right? So, we probably need a bit of time for the market to digest and be given some more volatility for things to stabilize. So for now, there is risk. I've got 42.85 as a big level. Below that, we're looking at potentially 41.40, which is the 200-day moving average, and also coincides with one of my Fibonacci levels, right? So those are, potentially in play still. And you've got FOMC obviously on Wednesday, which is going to be a key catalyst, right? So we had a nice reflexive bounce. Shouldn't be overly surprised to see some sort of reflexive bounce off those sort of moves that we saw yesterday. But I don't think we're necessarily out of the woods yet. We're going to need to see a positive market outcome off the FOMC, and we're going to need to kind of the street to get given some volatility back. Right now, there's an argument. If we have a look at what's going on in vol, obviously the VIX had a major spike. Looking at the VIX, it hasn't been up here since kind of May time, right? But then you look at all of these VIX spikes and how long they tend to last, right? They last probably a week max, right? Typically, right? Often less than that, maybe 2 or 3 days. So we've got FOMC on Wednesday. that could nip this whole vol spike in the bud already, and that would be a matter of days. Or we go into maybe quarter end, which is next week, next Thursday, and it could persist a bit longer if the FOMC outcome is not so favorable for markets, right? Bear in mind, markets are already reflecting a fairly high level of risk, right? We had mentioned last week that people were well hedged. There's been a demand for skew. There's a lot of people calling for a correction of a 5 to 10%. Now some people are even calling for a 20% correction. Morgan Stanley's Wilson came out with that. So there's a fair amount of bearishness out there, right? You look at some of these bull bear surveys, sentiment surveys, they're certainly not showing people are overly bullish, right? Certainly in the discretionary community, right? As I mentioned, a lot of the buying that's been going on is systematic, formulaic, passive flow type buying. It's not necessarily discretionary guys. Discretionary guys are leaning more short this market. They're trying to play this correction. Now we've had a bit of a correction, may or may not be over, but at some point, hedges are going to need to be unwound, right? And you saw that price action into the close yesterday. They don't give you a lot of chance to unwind your hedges, right? 50-point rally in the blink of an eye. That looks like a market. That looks like price action that shows that people are short, certainly short the S&P, right? They might not be short other things like Chinese property, but they're short the S&P as their hedge of choice. And that's where you get these quite squeezy moves as things get unwound, basically, right? So watch out for a bout of weakness still this week. There is a risk we could see 42.80 for me is a big level. There's a risk we could see that area. But if the Fed behaves itself, then we could also see vol collapsing back towards 20 easily, if not a bit lower, right? So and the vol sellers may well come out of the woodwork because it makes sense. The vol sellers have kind of held back a little bit with this major FOMC event to come, and vols are higher. They're going to wait to see what Powell says and then come and sell their vol as they normally do, basically. So that's kind of a setup, really, what we're seeing. Yeah. And on top of that, we haven't even mentioned if China come in with some supportive sort of actions, then you may get a big sort of recovery out of Asia as well, basically, right? So those are things to be on the lookout for. If we look at the kind of sector breakdown of what we saw into this sell-off, well, sort of unsurprising that cyclicals got whacked, right? You got the metals and mining was absolutely trashed, about 10% on the week. Clearly exposed to China. China is, a big demand driver in commodities. So if their property sector of all sectors, which accounts for like 30% of their economy, if that's going down, commodities going to get hit, right? So you had that sector down, you had energy down about 5%, and you had financials down about 4%. So those are your big cyclical sectors that are underperforming on the way down. Obviously on the bounce today, you should expect those to bounce accordingly as well. But then every sector was down, right? So, healthcare and retail outperformed, but every sector was down. Interestingly, the only thing really that I could see was up yesterday was airlines, right? Which, a bit surprising maybe, but airlines were probably reacting to the idea that Delta wave looks to have peaked, particularly in the US. We're certainly seeing that in the data of cases. And then you've got, the US dropping some travel restrictions, basically, right? So that was good for the airlines. And we actually saw some of those in the green on what was a very red day, which is quite encouraging price action for anyone who's trying to buy any of those sort of beaten up travel and leisure names, basically. So if this macro headwind can kind of pass, then arguably those names have got some legs in them. The fact that they managed to even rally in the face of that much weakness yesterday. Yeah. All right. So that's kind of it for equities. Now, obviously, Asian equities have been beaten up. I'm not going to say much on that other than Japan is looking a bit interesting. So, we've been talking about Japan. It's a big underweight. Obviously, they've got some politics going on. There's going to be some, there's going to be some will there to kind of pump their markets and keep things easy. So, Japan, if it's back in the spotlight, has arguably got a bit of outperformance coming. Other than that, Europe, people are saying European equities are a good own. They may well be longer term, but I think US equities are going to bounce harder than Europe. given the whole China thing. Obviously, if China has a bounce, if China has a strong bounce, then European equities will like that. But I just think if you're still a bit nervous on the Chinese consumer and the longer lasting impact of what's going on there, I'm not sure I'd be jumping into the DAX right now. Whereas I'd be a bit more comfortable buying the dip in things like S&P and NASDAQ, because I think they'll be more insulated from what happens in China. Yeah. Okay. And then this week, what's coming up? It's all about central banks, right? So you've got obviously Bank of Japan, I think overnight, you've got FOMC on Wednesday, you've got Bank of England on Thursday, and then you've got a bunch of Fed speakers again on Friday. And then in terms of macro data, nothing too huge. You've got some German IFO business climate surveys out on Friday, got some new home sales data, but nothing that market moving. So really it's going to matter. People are going to be dissecting the FOMC. That's the main event. There, you know, people, there's various schools of thought here. Some people think that what's going on in China and in markets right now might cause them to be a little bit more dovish than the market expects. Some people are saying it's too late for them to change what they're going to say. They want to get a taper out the door. They've already decided it. That's probably true. So I think on tapering, whatever they've decided, they've decided. In terms of the dot plot, that's what the market's really focused on, right? I think everyone's expecting some kind of taper, whether it starts in November or December. Is that going to massively change the outcome for markets? Markets kind of already expecting a taper. So I don't think that's the majorly hawkish event. If there's going to be a hawkish surprise out of this meeting, it's going to come from the dot plot. It's going to come from, is there going to be a hike next year? And, you know, how many hikes are we getting in 2024? Something like that, right? So that's what everyone's going to have their eye on, and that's going to determine what the yield curve does. So there is a risk, you know, with a hawkish surprise, there is a risk that the belly of the curve, that kind of, you know, I call it, you know, 5-year area really takes a beating. But you probably expect the curve to continue to flatten, right? So you'd expect the long end, like especially the 30-year stuff, to not really go up that much, right? As the market realizes that, okay, if you bring hikes forward, you're just going to take growth down longer term. And that's the way that dynamic seems to be playing out, right? On a hawkish surprise, yield curves seem to continue to flatten right now. Yeah, and I don't expect that dynamic to change. Yeah. FX, what's going on? So obviously the dollar had a spike, as you would expect. On that risk-off tone, the dollar catching a bid, also catching a bid because more and more people are thinking that there's potential for a hawkish kind of Fed this week. So the dollar's kind of going back up towards top end of that range. Hasn't broken out yet, but it definitely needs to be on the radar, right? If we get, like say, in S&P, if we break that 42.80, that's probably only happening with the dollar breaking this 94 area. If we zoom out on the dollar, where could the dollar go? Well, you know, that's a big sort of range resistance, 94, that gets us back, you know, heading towards potentially 96 to 98 area, right? So there is potential for the dollars to catch a bid if it breaks out. So this week's going to be interesting to see. It's not my base case. I reckon that 94 is probably going to hold again. You look at the momentum on the dollar, it's not crazy. It's not crazy high. And I don't know, me personally, I don't see the Fed coming out super hawkish. Yeah, but that's just my personal feeling. Okay. And then if you look at what's going on in yields, go to the bonds, 10-year, you know, yields are kind of trading in a range, holding pattern. That sort of downtrend in red has kind of been held. But you look at this sort of shorter term range here, we're chopping around, we're coiling basically, right? So this coiling price action is often what it does before a big move. Where's that big move going to come? Who knows? You know, in a big risk off kind of dynamic, that's probably going to break to the downside and we might retest this 110 area. Personally, I'm not even convinced that's going to happen, right? If you look at the way the price action was in that risk off yesterday, bonds barely budged, right? They were up a bit, but they weren't up anything like what you would expect. So that, you know, maybe that's positioning for this FOMC, people getting a bit hawkish. If they turn out not to be hawkish, then maybe, yeah, we get that breakdown in yields, we'll see. But, you know, not overly exciting yields right now, to be honest. And even if we do break a bit higher, as I've mentioned in previous weeks, the foreign demand for treasuries is going to be there, right? If you compare FX adjusted yields in Japan and Europe, that foreign demand isn't going to disappear. So if yields pop and i.e. treasuries sell off, I think they'll be met with some buying basically, right? So I expect yields to actually remain fairly range bound after this FOMC. Yeah. Okay. So that's rates and bonds, rates and FX, sorry. If we want to go now to commods. What's going on in commods? Some interesting price action. Obviously, commodities massively impacted by China, or they typically tend to be. So the big daddy of commodities, oil, what did it do? Pulled back a bit, but it actually held really well, right? The price action in oil, I would say, was super constructive yesterday, right? As everything else continued to melt down throughout the day, oil was just holding, right? It just didn't want to budge. Now, metals, on the other hand, were getting hammered, but oils were holding. Why was oil holding? Stronger demand that we're seeing likely post the COVID peak. The gas and power markets are going nuts. There's a massive squeeze going on in gas. So people may be needing to look at fuels for alternative ways of getting that sort of those demands, those energy demands met. And then, you know, you've got inventory drawdowns as well been going on everywhere, right? So definitely very constructive for oil. You know, that has really got the potential to break out as we go into year end, basically. So I'm long it for now. I have trailed my stop a bit higher given what's going on in the macro. So, you know, I'm being prudent with the view, but right now I'm long and I'm not doing a lot with it right now. And then if we want to look at metals, which is probably the other interesting thing, copper, you know, testing its support zone. Get rid of this one. So copper testing support here, got two major supports sort of around the low 4s and then 385. Tested that support again, kind of held it for now. I'm not rushing to buy copper here. I've got it in my long-term book, love it for the long term, not adding tactical longs right now, thinking that a test of that 385 is what I want to see. If I can see that and the momentum gives me some bullish divergence, and I think this China thing is kind of, you know, bottoming out, then I might dip my toes in and buy some copper, but I'm not rushing out the door to do it right now. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.